I need to warn you about something that is silently destroying the retirement savings of millions of Americans. It is a trap that has been carefully designed to look helpful. Even beneficial financial institutions spend billions of dollars every year convincing people that this trap is actually a service. And most people fall into it without ever realizing how much it is costing them by the time they figure it out. If they ever do, they have lost hundreds of thousands of dollars. Money that should have been theirs. Money that could have funded a comfortable retirement. Money that instead went into the pockets of Wall Street. I am talking about excessive investment fees, and I am going to show you exactly how this trap works, exactly how much it is costing you, and exactly how to escape it. This is not a small problem. This is not a rounding error. The difference between paying high fees and low fees over a 30 or 40-year career can easily exceed $500,000. For some people, it exceeds $1 million. That is not an exaggeration. That is mathematics. And once you understand the math, you will never look at your retirement accounts the same way again. Let me start by explaining how this trap was built. Decades ago, the financial industry figured out something important. Most people do not pay attention to fees. They focus on returns, on performance, on which fund went up the most last year. Fees seem small and boring. A 1% fee does not sound like much. What is 1%? A penny for every dollar. Who cares about a penny? The financial industry cares. They care very much because that 1 penny multiplied by trillions of dollars in retirement assets, multiplied by decades of compounding, adds up to one of the most profitable businesses in the world. The asset management industry collects hundreds of billions of dollars in fees every single year. And most of that money comes from people who do not even realize they are paying it. Here's how the math works. And I want you to pay close attention because this is where the trap becomes visible. Let us say you are 30 years old with $50,000 in your retirement account. You plan to retire at 60. 5, giving you 35 years of investing ahead of you. You add $10,000 per year to your account. The stock market returns an average of 10% per year before fees. Now let us compare two scenarios. In the first scenario, you invest in a low-cost index fund with a fee of 0.03% per year. That is $3 per year for every $10,000 invested. In the second scenario, you invest in actively managed funds with fees of 1% per year. That is $100 per year for every $10,000 invested. The difference is $97 per year per $10,000. That sounds small, right? Less than $100. Who would worry about that? Here's what happens over 35 years. In the low-cost scenario, your portfolio grows to approximately $4.8 million. In the high-cost scenario, your portfolio grows to approximately $3.7 million. The difference is $1.1 million over $1 million gone. Not because you made bad investment decisions, not because the market performed poorly, simply because you paid 1% in fees instead of 0.03%. $1 million. That is the cost of the retirement trap. That is what Wall Street is taking from you while telling you they are providing a service. And I want to be clear about something. That 1% fee is not unusual. Many actively managed mutual funds charge 1% or more. Some charge 1.5%. Some charge 2%. Add in trading costs, administrative fees, and other hidden charges, and total costs can easily exceed 2% per year. A 2% in annual fees, that same investor would end up with only $2.8 million instead of $4.8 million. That is $2 million lost to fees. $2 million that should have funded their retirement, their children's inheritance, their charitable giving gone, transferred from their pocket to Wall Street's pocket. This is the trap, and tens of millions of Americans are caught in it right now. Let me tell you why this happens. Why do people pay high fees when low-cost alternatives exist? The first reason is ignorance. Most people simply do not know what they are paying in fees. The fees are disclosed technically somewhere in the fine print of a prospectus that nobody reads. The fees are listed, but they are not presented in a way that makes the true cost clear. Nobody shows you the $1 million calculation I just did. Nobody explains what those fees will cost you over a lifetime of investing. The financial industry likes it this way. They spend enormous amounts of money on marketing that emphasizes everything except fees. They talk about performance, about expertise, about sophisticated strategies. They create complicated products that seem impressive. They use jargon that makes people feel like they need professional help. And they never ever emphasize how much that help is costing. The second reason is misplaced trust. Many people invest through financial advisors who recommend high-fee products. These people trust their advisors. They assume the advisor is acting in their best interest. They do not realize that many advisors are compensated based on which products they sell, not based on how well their clients do. If an advisor earns a commission for putting you into a high-fee fund, guess which fund they are going to recommend. This is not necessarily malicious. The advisor may genuinely believe the fund is good, but the conflict of interest is real, and it costs investors billions of dollars every year. The third reason is the illusion of value high. Fee funds are often marketed as premium products. They have prestigious names, famous managers, sophisticated strategies. Paying more feels like getting more. It is the same psychology that makes people pay extra for brand name products, even when generic alternatives are identical. But in investing, paying more does not get you more. The data is overwhelming and unambiguous. On average, high-fee actively managed funds underperform low-fee index funds, not sometimes, not in certain market conditions. On average, over time, across almost every category, the expensive funds lose to the cheap funds. This seems counterintuitive. Should not the expensive funds, with their teams of analysts and sophisticated strategies, be able to beat a simple index fund that just buys everything in the market? And here is why. Before fees, investing is a zero-sum game. For every dollar someone makes above the market average, someone else must make $1 below the market average. That is just math. All the stocks in the market add up to the market. If you beat the market, someone else must trail it. Now add fees. The high-fee funds charge 1% or more. The index funds charge nearly nothing. After fees, the high-fee funds have to beat the market by more than 1% just to match the index fund's return. Most of them cannot do that consistently. Year after year, study after study, the results are the same. Over 15-year periods, more than 90% of actively managed large-cap funds underperform the S&P 500 index. 90%. That means if you pick an actively managed fund, you have less than a 10% chance of beating a simple, low-cost index fund. And you are paying extra for that privilege. You are paying 1% per year for a 90% chance of underperformance. That is the trap. I have been saying this for decades. I have told people over and over again that for most investors, the best thing they can do is buy a low-cost S&P 500 index fund and hold it forever. I have bet $1 million on this proposition and won. I have made it the centerpiece of my advice to individual investors, and still, trillions of dollars remain in high-fee funds. The trap is that powerful. The marketing is that effective. The ignorance is that widespread. Let me show you some specific examples of how this trap manifests in real retirement accounts. The first example is target date funds in 401k plans. Target date funds are designed to be simple, all-in-one retirement investments. You pick the fund with a date closest to when you plan to retire, and the fund automatically adjusts its allocation as you age. The concept is good. The execution is often terrible. Many target date funds charge fees of 0.5 to 0.7% per year. Some charge even more. Meanwhile, you could build your own target date portfolio using low-cost index funds for 0.1% or less. That difference, 0.4 to 0.6% per year, compounds into enormous sums over a career. And here's the worst part. Many 401k plans only offer expensive target date funds. The plan administrators have selected these funds often because the fund companies pay to be included in the plan. The employees have no choice but to pay the high fees or navigate a confusing array of other options. The second example is wrap accounts and managed accounts offered by brokerages. These accounts charge an annual fee, typically 1% of assets, to manage your portfolio. In exchange, you get access to a team of professionals who will select investments for you. What do those professionals typically do? They put your money into mutual funds, often expensive ones, and collect their 1% on top of whatever the mutual funds charge. So you end up paying 2% or more in total fees for a service that rarely beats a simple index fund portfolio. The third example is variable annuities sold to retirees. These products are incredibly complex and incredibly expensive. Annual fees of 2 to 3% are common. Surrender charges lock you in for years. And the tax benefits that are often used to justify these products are available through much cheaper alternatives like IRAs and 401k plans. Variable annuities are one of the most profitable products for insurance companies and the salespeople who sell them. They are one of the worst products for consumers, yet billions of dollars flow into them every year because the sales pitches are compelling and the true costs are hidden. The fourth example is funds of funds and alternative investments marketed to wealthy individuals. These products charge fees on top of fees. A fund of hedge funds might charge 1% plus collect a share of profits, and then each underlying hedge fund charges 2% plus 20% of profits. The total fees can easily exceed 3% per year. These products are marketed as sophisticated, exclusive, available only to accredited investors. The high fees are justified by claims of superior returns. But the data shows that most of these products underperform simple index funds, especially after fees. The sophistication is an illusion. The exclusivity is a marketing tactic. The fees are real now. Let me tell you how to escape the trap. The first step is awareness. You need to know what you are paying. Go through every investment account you have. Look up the expense ratio of every fund you own. Add up the total fees you are paying. If you work with a financial advisor, find out exactly what they charge, including any commissions or revenue sharing arrangements. Knowledge is power. You cannot fix a problem you do not understand. The second step is simplification. You do not need dozens of funds. You do not need sophisticated strategies. You do not need alternative investments. A simple portfolio of low-cost index funds will outperform most complicated portfolios over the long term. 3 funds can give you everything you need. A total U.S. stock market index fund, a total international stock market index fund, a total bond market index fund. That is it. 3 funds properly allocated based on your age and risk tolerance will serve you better than almost any alternative. The third step is choosing the right providers. Some investment companies have made low-cost investing their mission. Vanguard, founded by Jack Bogle, pioneered index investing and still offers some of the lowest fees in the industry. Fidelity and Schwab have followed with their own low-cost options. These companies offer index funds with expense ratios of 0.03% or less. There is no reason to pay more. The fourth step is optimizing your 401k. If your employer's 401k plan has high fee options, lobby for better alternatives. Talk to your HR department. Point out that high fees are costing employees hundreds of thousands of dollars over their careers. Many companies do not realize how bad their plans are. Employee pressure can lead to change. If your 401k options are truly terrible and cannot be changed, consider contributing only enough to get any employer match. Then directing additional savings to an IRA where you have complete control over investment options. Yes, you might miss some tax benefits of the 401k, but those benefits can be overwhelmed by high fees. The fifth step is avoiding salespeople. Anyone who is trying to sell you a financial product is probably not acting in your best interest. The more aggressively something is sold, the worse it usually is for the buyer. Good investments do not need to be sold. They speak for themselves. If someone is pushing you toward a particular product, especially a complicated one, be very skeptical. The sixth step is staying the course. Once you have built a low-cost portfolio, leave it alone. Do not tinker. Do not try to time the market. Do not chase performance. Every change you make is an opportunity to incur costs and make mistakes. The power of low-cost investing comes from buying, holding, and letting compound interest work over decades. Let me address some objections you might be thinking. Objection 1. But my advisor provides valuable services beyond just picking investments. They help me with financial planning, tax strategies, estate planning. Is that not worth 1% per year? Maybe, but probably not. A 1% annual fee on a $1 million portfolio is $10,000 per year. Over 20 years, that is $200,000 plus the lost compound growth on that money. Are you getting $200,000 worth of advice? For most people, the answer is no. If you need financial planning help, consider paying for it directly through hourly fees or flat project fees. This separates the advice from the investment management. You pay for what you need when you need it, rather than bleeding 1% of your assets every single year forever. Objection 2. Index funds are fine for most people, but I am a sophisticated investor. I can identify managers who will beat the market. No, you probably cannot. Professional pension fund managers, endowment managers, people who do this full-time with enormous resources cannot consistently identify outperforming managers in advance. What makes you think you can? The data is clear. Past performance does not predict future performance. Hot funds turn cold. Star managers flame out. Trying to pick winners is a loser's game. Objection 3. I do not have time to manage my own investments. I need someone to do it for me. A low-cost index fund portfolio requires almost no management. You set your allocation once, rebalance once per year, and otherwise do nothing. This takes maybe an hour per year. If you do not have an hour per year to save hundreds of thousands of dollars, you need to rethink your priorities. Objection 4. High-fee funds provide better service, more information, better reporting. The service, information, and reporting are not worth the fees. A quarterly statement from an expensive fund looks prettier than a quarterly statement from Vanguard. So what that pretty statement costs you $1 million over your lifetime. I would rather have the $1 million let me tell you what I have done with my own money and what I have instructed for my estate, for my wife's inheritance. I have specified that 90% should go into a low-cost S&P 500 index fund and 10% into short-term government bonds, not into hedge funds, not into private equity, not into any of the sophisticated investments that wealthy people are supposed to use. A simple, low-cost index fund. Why? Because I know that this simple approach will outperform almost any alternative over the long term. The fees will be negligible. The diversification will be automatic. The results will be better than what most professional managers achieve. If this approach is good enough for my wife, it should be good enough for you. I want to share some numbers that illustrate just how much the financial industry extracts from investors. The mutual fund industry in America manages approximately $25 trillion. If the average fee is 0.5%, that is $125 billion per year in fees. $125 billion transferred from investors to fund companies every single year. And what do investors get for that $125 billion? On average, they get worse performance than they would have gotten from index funds costing a fraction of the price they are paying for underperformance. The financial advisory industry manages additional trillions of dollars and extracts additional tens of billions in fees. The insurance industry extracts billions more through annuities and other products. The hedge fund industry extracts billions more from wealthy investors. All told, the financial industry probably extracts $300 billion or more from American investors every year. That is $300 billion that could have stayed in investors' pockets, compounded over time, and funded better retirements. This is not a victimless situation. Real people are retiring with less money because of fees. Real people are working longer than they need to because fees have depleted their savings. Real people are leaving smaller inheritances to their children because fees have consumed their wealth. The financial industry will tell you that they provide valuable services. They will tell you that their expertise is worth the cost. They will tell you that managing money is complicated and requires professional help. Do not believe them. Managing money for retirement is not complicated. Buy low-cost index funds, hold them for decades. Rebalance occasionally. That is it. You do not need Wall Street's help. You do not need to pay 1 or 2% of your assets every year for something you can do yourself for nearly free. The retirement trap is real. Millions of Americans are caught in it, but you do not have to be one of them. You can escape. You can keep your money instead of giving it to Wall Street. You can retire with hundreds of thousands of dollars more than you would have otherwise. All it takes is awareness and action. Now you are aware. The question is whether you will take action. Go look at your retirement accounts today. Add up the fees you are paying. Calculate what those fees will cost you over your remaining investing lifetime. Then make changes. Move your money to low-cost index funds. Fire expensive advisors. Get out of high-fee products. Every day you wait is a day the trap continues to work. Every year you delay is tens of thousands of dollars lost to fees. The time to act is now. I have been in this business for over 70 years. I have seen every trick, every scheme, every way that Wall Street separates people from their money. And I am telling you that excessive fees are the biggest, most pervasive, most damaging trap of all. Not because each individual fee is large, but because the fees compound relentlessly over decades, consuming wealth that should have been yours. You have worked hard for your money. You have sacrificed and saved and planned for the future. Do not let Wall Street take a quarter or a third or half of what you have built. Keep your money. Invest it simply and cheaply. Let compound interest work for you instead of against you. That is my warning. That is the trap. And now you know how to avoid it. The rest is up to you. Let me go even deeper on this topic because I want you to fully understand the magnitude of what we are discussing. When I talk about the retirement trap costing you thousands, I am actually being conservative for many people. The cost is hundreds of thousands for some. It exceeds $1 million. These are not hypothetical numbers. These are the actual mathematical consequences of paying high fees over an investing lifetime. Let me walk you through another example to make this crystal clear. Consider a couple, both 30 years old, who together earn $150,000 per year. They save 15% of their income for retirement, which is $22,500 per year. They plan to retire at 67, giving them 37 years of saving and investing. If they invest in low-cost index funds with total fees of 0.1% per year, and the market returns an average of 9% annually, they will retire with approximately $6.3 million. If they invest in high-cost, actively managed funds with total fees of 1.5% per year, with the same market return, they will retire with approximately $4.2 million. The difference is $2.1 million, $2.1 million lost to fees. That is enough to fund an extra decade of retirement. That is enough to leave a substantial inheritance to children and grandchildren. That is enough to make a transformational charitable gift. Gone transferred to Wall Street. And remember, this example assumes the high-fee funds match the market's return before fees. In reality, most high-fee funds underperform the market before fees, making the gap even larger. The true cost of the high-fee funds could easily exceed $3 million. Now multiply this by the millions of American households who are caught in this trap. The aggregate wealth transfer from ordinary savers to the financial industry is almost incomprehensible. We are talking about hundreds of billions of dollars per year flowing from people who need the money for retirement to corporations and executives who are already wealthy. This is not illegal. This is not fraud. This is a business model that has been carefully constructed to be technically compliant with all regulations while extracting maximum fees from unsuspecting investors. The disclosures are made, the fees are listed somewhere, but the presentation is designed to minimize understanding, not maximize it. I have long advocated for clearer fee disclosure. I have suggested that every fund statement should show in bold letters exactly how much money was paid in fees that year and the cumulative fees paid over the life of the account. I have suggested that projections should show what the account would have been worth with lower cost alternatives. These simple changes would open people's eyes, and that is exactly why the industry fights against them. Let me tell you about some of the specific fee structures that are most harmful. The first is the 12b-1 fee. This is a fee that mutual funds charge to cover marketing and distribution costs. In other words, you pay a fee so the fund company can advertise to get more investors. How does this benefit you, the existing investor? It does not. It is simply a way to extract additional fees under a legitimate sounding name. The second is revenue sharing. This is when mutual fund companies pay 401k plan administrators to include their funds in the plan. Where does that payment come from? From the fees paid by investors like you. So you pay higher fees. And part of those fees goes to the plan administrator as a kickback for including the expensive fund in the plan. Everyone benefits except you. The third is soft dollar arrangements. This is when brokerage firms provide research and other services to fund managers in exchange for directing trading business their way. The cost of these services is embedded in trading costs, which come out of fund returns. You never see a line item for soft dollars, but you pay for them through reduced returns. The fourth is performance fees on top of management fees. Some funds charge a base management fee plus a percentage of any gains. This sounds fair at first. The manager only profits when you profit, but the incentives are actually terrible. The manager is rewarded for taking excessive risk. If the bet pays off, they get a share of the gains. If it fails, they still collect the base fee while you bear all the losses. The fifth is account fees, transaction fees, and administrative fees that pile up beyond the stated expense ratio. Your fund might have an expense ratio of 1%, but then you pay an account maintenance fee, a statement fee, a transaction fee every time you buy or sell, and various other charges that are not included in the expense ratio. The total cost can be significantly higher than the headline number. All of these fees have one thing in common. They transfer money from your pocket to someone else's pocket. They do not improve your returns. They do not reduce your risk. They do not provide value commensurate with their cost. They are simply a tax on your wealth, paid year after year, compounding against you over decades. Let me talk about why the financial industry has been able to get away with this for so long. Part of it is complexity. The financial industry has made investing seem complicated. They use jargon that ordinary people do not understand. They create products with dozens of features and options. They produce thick prospectuses filled with legal language. This complexity serves two purposes. It makes people feel like they need professional help, and it obscures the true cost of that help. Part of it is trust. People trust their financial advisors. They trust the big-name investment firms. They assume that these professionals are acting in their best interest. They do not realize that the industry is riddled with conflicts of interest, that advisors are often paid based on what they sell rather than how well their clients do. Part of it is inertia. Once people are invested in high-fee products, they tend to stay there. Switching requires effort. It requires admitting that you made a mistake. It requires facing the uncomfortable reality of how much money you have lost to fees. It is easier to do nothing, even when doing nothing costs thousands of dollars per year. Part of it is marketing. The financial industry spends billions of dollars on advertising that emphasizes everything except fees. They market past performance, even though past performance does not predict future results. They market expertise and prestige. They market security and peace of mind. They never market the one thing that actually matters for long-term returns, which is cost. And part of it is regulatory capture. The financial industry has enormous political influence. They lobby against regulations that would require clearer fee disclosure. They fight rules that would impose fiduciary duties on advisors. They shape the regulatory environment to protect their profits at the expense of investors. This is why change has been so slow, why the trap persists, why trillions of dollars remain in high-fee products, despite all the evidence that low-cost alternatives are better. But things are changing. Slowly, the rise of index investing has been one of the most positive developments for ordinary investors in my lifetime. When Jack Bogle founded Vanguard and introduced the first index fund for individual investors in 1970, he was ridiculed by the industry. They called index investing guaranteed mediocrity. They said investors would never be satisfied with average returns. They were wrong. Index funds have grown from nothing to trillions of dollars in assets. Low-cost investing has gone from a fringe idea to the mainstream. Fees across the industry have fallen as competition from index funds has forced actively managed funds to lower their prices. But we are not finished yet. Trillions of dollars still sit in high-fee products. Millions of Americans are still caught in the trap. The financial industry is still extracting hundreds of billions of dollars per year from people who cannot afford to lose it. I want to give you some specific action steps to protect yourself. Action step 1, calculate your total investment costs right now. Go through every retirement account, every brokerage account, every investment you own. Find the expense ratio for each fund. Add up the total fees as a percentage of your assets. Then convert that to dollars. If you have $500,000 and your average expense ratio is 1%, you are paying $5,000 per year in fees. Write that number down, look at it. Feel it, that is money coming out of your pocket. Action step 2, compare your funds to low-cost alternatives. For every actively managed fund you own, find a comparable index fund and compare the expense ratios. If you own an actively managed large-cap fund charging 1%, compare it to an S&P 500 index fund charging 0.03%. Ask yourself what you are getting for that extra 0.97%. The answer is almost certainly nothing. Action step 3, make a plan to transition to low-cost investments. You do not have to do this all at once. You can move money gradually to minimize any tax consequences, but make a plan and execute it. Every month you delay is another month of excessive fees. Action step 4, if you work with a financial advisor, have an honest conversation about fees. Ask them exactly what you are paying in total, including their fee, the fees of the underlying investments, and any other charges. Ask them to justify those fees with evidence that you are getting better results than you would from a simple index fund portfolio. If they cannot justify the fees, find a new advisor or manage your money yourself. Action step 5, optimize your 401k. Even if you cannot change the fund options in your plan, you can make smart choices among the options available. Look for the lowest cost index funds in each asset class. Avoid the target date funds if they have high fees. If your plan has a brokerage window that allows you to invest in funds outside the plan's core lineup, use it to access lower cost options. Action step 6, consider a fee-only financial advisor if you need help. Fee-only advisors charge a flat fee or hourly rate for their advice. They do not earn commissions on products they sell. This removes the conflict of interest that plagues commission-based advisors. You might pay a few $100s for a financial plan, but that is far better than paying 1% of your assets every year forever. Action step 7, educate your friends and family. The retirement trap persists partly because people do not talk about fees. They are embarrassed to admit they do not understand their investments. They do not want to seem unsophisticated. Break that silence. Share what you have learned. Help others escape the trap too. I want to conclude by putting this in the broadest possible context. Building wealth for retirement is one of the most important financial tasks most people will ever undertake. It requires decades of discipline, sacrifice, and patience. It means foregoing consumption today so you can have security tomorrow. It is hard work. The financial industry should be helping people with this task. Instead, a significant portion of the industry is making the task harder by extracting excessive fees. They are taking a cut of your sacrifice. They are diminishing your security. They are profiting from your hard work. This is not right. It is legal, but it is not right. And you do not have to accept it. You have the power to escape the trap. You have the knowledge now. Low-cost index funds are available to everyone. Simple, effective investment strategies do not require expensive advisors. The tools you need to build a secure retirement are accessible and affordable. Use them. Do not let Wall Street take what you have earned. Do not let fees consume the wealth you have built. Do not fall for the marketing, the complexity, the illusion of expertise. Keep your money. Invest it simply and cheaply. Watch it compound over decades without being diminished by excessive fees. Retire with hundreds of thousands more than you would have otherwise. That is the path to a secure retirement. That is how you escape the trap. And that is my urgent message to you today. The trap is real. The cost is enormous. But the solution is simple. Act now and keep the money that is rightfully yours.